In January 2026, banks will publish their first Basel III crypto exposure disclosures. You're going to see exactly how deep bank crypto adoption has become. But banks aren't buying Bitcoin for speculation. They're using stablecoin payment rails, tokenized deposits, and crypto collateral to transform Treasury operations. I'm going to walk you through what banks are doing with crypto, what January 2026 Basel III disclosures will reveal, and whether your business should consider a crypto-enabled treasury. I'm John Conrad with Numeratus. We're a white glove accounting firm, and we help businesses navigate the intersection of traditional finance and crypto. Everything you can imagine a big firm doesn't want to touch. Crypto-enabled treasury, stablecoin accounting, digital asset risk controls, that's what we do. We've been tracking institutional crypto adoption. We've helped clients evaluate stablecoin payment rails, model crypto treasury strategies, and implement controls for digital asset operations. So this brings us to our first point. What bank crypto adoption actually looks like. Let me explain what banks are doing with crypto, because it's not what most people think it is. Banks aren't replacing dollars with Bitcoin. They aren't speculating on crypto prices. They aren't abandoning traditional finance for DeFi. And what banks are actually doing, they're using stablecoin rails for payments. Banks are piloting systems to settle payments using stablecoins, especially USDC and USDT, because they're faster and cheaper than traditional correspondent banking. Tokenizing deposits. Some banks are experimenting with tokenized deposits, representing traditional bank deposits as tokens on a blockchain for faster settlement. Accepting crypto as collateral. A few banks are accepting Bitcoin and other crypto as collateral for loans, similar to how they accept stocks or real estate. Some banks are even providing custody services. Major banks are offering crypto custody services to institutional clients. They're building private blockchains. Banks are building permissioned blockchain networks like JP Morgan's JPM coin for internal settlement and client payments. For example, a major bank might not hold Bitcoin on its balance sheet for speculation, but they might use stablecoin rails to settle international payments with another bank because it's faster. We're talking about minutes versus days, and it's cheaper. We're talking about $5 versus $50 in correspondent banking fees. Or a bank might accept Bitcoin as collateral for a $10 million loan to a crypto company because the company has Bitcoin but needs cash without selling the Bitcoin on its balance sheet and triggering a taxable event. This is practical utility, not speculation. This brings me to my second point. Stablecoin payment rails and their big shift. Stablecoin payment rails are the most significant near-term shift in how banks operate. What stablecoin rails actually are. Stablecoins like USDC and USDT Tether are dollar-backed crypto tokens that trade one-to-one with the US dollar. They settle on blockchain networks like Ethereum and Solana in minutes, 24/7, with minimal fees. So why are banks interested in stablecoin payment rails? The speed. Traditional wire transfers take 1 to 3 business days. Stablecoin transfers settle in minutes. Cost. Wire transfers cost $25 to $50. Stablecoin transfers cost 50 cents to $5. The 24/7 settlement. Banks are only open during business hours. Blockchains run 24/7, 365 days a year. We're even looking at the programmability. You can program stablecoin payments with smart contracts and automatic execution when conditions are met. So what are some real-world use cases? International remittance. Sending money internationally via traditional correspondent banking involves multiple intermediaries and takes days. Stablecoins settle directly in minutes. There's B2B payments. Paying vendors internationally with stablecoins instead of wire transfers saves time and, of course, money. And then we come to treasury management. Moving money between accounts for entities faster and cheaper. For example, a US company needs to pay a supplier in Singapore. Traditional wire transfer of $50, 2 to 3 business days to settle, and involves 3 to 4 correspondent banks. Stablecoin transfers is a $2 fee, 5-minute settlement, direct peer-to-peer. The supplier receives the USDC, converts to Singapore dollars at a crypto-friendly bank or exchange. You're saving $48 in fees, 2 to 3 days of time. If this company makes 100 international payments per year, That's $4,800 saved and significantly faster operations. Now let's talk about the big players. Visa and MasterCard are piloting stablecoin settlement networks. So that brings in SWIFT, right? The global interbank messaging system. And they're exploring stablecoin integration. JP Morgan has their JPM coin for institutional clients. And with the Genius Act passing in 2025, stablecoins now have federal regulatory clarity, which accelerates adoption. By the way, we help businesses model crypto-enabled treasury strategies at Numeratus. If you're considering stablecoin payment rails, we can help you evaluate the fees, settlement benefits, accounting treatment, and risk controls. But let's get back into it. Now we come to the third point. Basel III's crypto disclosures. What's coming in January 2026? In January 2026, banks will start publishing standardized crypto exposure disclosures under Basel III framework. This will reveal exactly how much crypto exposure banks actually have. What are the requirements for the Basel III crypto rules? Banks with crypto exposures must disclose total crypto asset holdings, the type of exposure, spot holdings, derivatives, custody services, lending with crypto collateral, risk weights applied, how much capital must be held against the crypto risk, geographic and currency breakdown, treatment in capital, and liquidity ratios. So why does this even matter? For the first time, we'll have standardized, comparable data on bank crypto adoption. No more guessing. Banks will publish actual numbers. And what we'll learn: which banks are actually using crypto versus just talking about it. How much crypto exposure is concentrated in a few large banks versus distributed. Whether banks treat crypto as high risk, high capital requirements, or moderate risk, and how crypto fits in overall bank risk management. What's the market impact? Once investors and regulators see the actual data, capital will flow to banks that have successfully integrated crypto with proper risk controls. Banks that have avoided crypto entirely might face pressure from shareholders to explain why they're missing this opportunity. For example, a bank publishes its January 2026 Basel III crypto disclosure. They have $500 million in tokenized deposits. They have $200 million in custody revenue. They have $100 million in crypto collateralized loans. They have risk weight of moderate, which is not the highest category. And they have capital adequacy maintained above requirements. Investors see this bank is successfully using crypto for revenue generation while maintaining proper risk controls, stock price benefits. Another bank publishes zero in crypto exposure, no pilots, no custody, no involvement. Investors see the bank is behind on innovation. Why aren't they capturing the stablecoin payment market that's growing 300% year over year? Stock price pressure. And now we're at point number 4, tokenized deposits versus stablecoins, and understanding the difference. Let me clear up confusion between tokenized deposits and stablecoins because they're different things. Stablecoins are issued by non-bank companies, Circle, Tether, backed by reserves such as cash or treasury bills, and they trade on public blockchains, which are regulated under the Genius Act of 2025. Tokenized deposits are issued by banks. They represent actual bank deposits that can be transferred on blockchain rails, and they're still FDIC insured, if the bank is insured, of course. Why banks prefer tokenized deposits? Banks can issue them without regulatory uncertainty. Stablecoin issuers need special licenses in order to create stablecoins. They remain within the banking regulatory framework. They're FDIC insured, which stablecoins aren't. Why users might prefer stablecoins. Stablecoins work across banks and borders seamlessly. They're more programmable for smart contracts. They're more established, like USDC and USDT had been around for many years. So what's the likely future? Both will coexist. Stablecoins for cross-border and crypto-native use cases. Tokenized deposits for traditional banking relationships with blockchain efficiency. For example, a corporate treasury might use stablecoins for international vendor payments where speed and cost matter. Then they might use tokenized deposits for moving money between their own accounts at different banks. And there might be traditional wire transfers for large transactions where counterparty risk is a concern. Each tool for its best use case. Now, point number 5, crypto collateralized lending, the risk and of course the opportunity. Some banks are accepting crypto as collateral for loans. This creates both opportunities and, of course, risk. How it works. Borrowers pledge Bitcoin or other crypto as collateral. Banks lend cash at a loan-to-value ratio, typically 25 to 50% of the crypto value. If crypto value drops too much, banks issue a margin call. If not met, the bank liquidates the crypto to repay the loan. So why borrowers want this? They can access cash without selling crypto. They avoid taxable events and maintain long-term capital gains positions. There are lower interest rates than unsecured loans and fast access to liquidity. So why are banks interested? There's attractive interest rates. We're talking about 8 to 12% versus 5 to 7% for traditional loans. Over collateralized loan is 25 to 50% of collateralized value, so significant price buffer. Wealthy crypto holders need banking services. Risks, volatility. Crypto prices can drop 30 to 50% in days. Banks need conservative ratios and attractive risk monitoring. There's liquidation risk. Margin calls and liquidations cascade, exacerbating market crashes. There's custody risk. Banks must securely hold the crypto collateral. One security breach could be catastrophic. And there's regulatory risks. As Basel III rules take effect, banks might need to hold more capital against crypto collateralized loans. For example, a crypto investor has $10 million in Bitcoin. They need $3 million cash for a real estate investment. Option 1, sell $3 million in Bitcoin. The result is $3 million in cash, but they owe $900,000 in capital gains taxes, which is about 30%, and they net $2.1 million after taxes. And then there's option 2, the crypto collateralized loan. They pledge $10 million in Bitcoin. They borrow $3 million at 10% interest. The result is $3 million in cash, no taxes. The Bitcoin is still owned, but cost $300,000 a year in interest. The real estate investment generates 15% or more in returns. Option 2 is better. Plus, if Bitcoin appreciates, they keep all the upside. Risk, if Bitcoin drops 60%, the loan is under collateralized. The bank issues a margin call. The borrower must add collateral or the bank liquidates the holdings. Now this brings us to our last point. Should your business consider crypto treasury in 2026? Here's how to evaluate whether crypto-enabled treasury makes sense for your business. Consider crypto treasury if you make frequent international payments. Stablecoin rails can save significant time and money on cross-border transactions. You have vendors and customers who prefer crypto payments. Increasingly common in tech, crypto-native, and international businesses. You want faster settlement. You need to move money quickly outside banking hours. You're in a high-fee banking relationship. Wire fees, foreign exchange fees, and correspondent banking fees add up. Don't consider crypto treasury if you can't implement proper controls. Crypto requires different security and accounting controls than traditional banking. Your business has minimal international exposure. Domestic wire transfers are less painful than international ones. You're in a highly regulated industry. Banks, insurance, certain government contractors face additional regulatory hurdles for crypto. Your accounting team isn't prepared. Proper crypto accounting requires specialized knowledge. So here's an implementation checklist. Number 1, evaluate potential savings. So model fees, FX spreads, and time value. Number 2, assess your risk tolerance, the volatility, the custody, and the regulatory side of things. Number 3, implement proper controls, multi-sig wallets, and approval processes. Number 4, train accounting team, crypto transactions, the reconciliation, and the tax treatment. Number 5, choose service providers. Choose exchanges, custodians, and payment processors. Number 6, start small. Pilot program with one vendor or one payment type. Number 7, monitor and scale. Track actual savings and issues. For example, a software company with 20 international contractors evaluates stablecoin payments. The current state, $25,000 a month in contractor payments via wire transfer. The cost is $50 per wire. Times 20 is $1,000 a month in fees. The time, 2 to 3 days to settle. The proposed state is $25,000 a month in contractor payments via stablecoins. The cost is $2 a transfer. Times 20 is $40 a month in fees. Time, 5 minutes to settle. Annual savings, $11,520 in fees, plus significant time savings. Happier contractors, faster payments. The implementation costs, $5,000 to set up. You have training, you have controls, you have systems. The break-even point is about 5 months. So what's the decision here? Implement stablecoin payments as a pilot. After 6 months, evaluate success and consider expanding. The result: successful implementation. Contractors are happy with faster payments. The company saves $11,520 a year ongoing. Banks are adopting crypto infrastructure in ways that will fundamentally change treasury management. Stablecoin rails, tokenized deposits, and crypto collateral are moving from experimental to mainstream. This video showed you what's happening and how to evaluate whether your business should participate. The before and the after. The bridge to implementing crypto-enabled treasury correctly is where Numeratus comes in. If you want to stay informed about bank crypto adoption, stablecoin regulations, and treasury innovations, join the Numeratus community at numeratus.org for $100 a month. We track institutional adoption and break down what it means for businesses. If you need hands-on guidance, if you want to evaluate stablecoin payment rails for your business, model the cost savings versus traditional banking, implement proper accounting and controls, or understand the tax treatments, book a consultation at numeratus.us. Ask Numeratus to model a crypto-enabled treasury, the fees versus the settlement benefits, the accounting treatment, and the risk controls. We specialize in helping businesses navigate crypto adoption. That sounds interesting to you? Book a call.